If you make less than $250,000 a year, the biggest mistake you can make is going to your bank for a mortgage. And let me tell you why that is the case. Hi there, I'm Ella Gurfinkel, Team Ella, Fairway Independent Mortgage, and I'm going to tell you today why so many people make the biggest mistake of their life by going to their bank to get a mortgage if they make less than $250K a year. If you're in the category where most of my clients really are and find themselves in, and that's making a combined less than $250,000 a year, they're not really a subject to private banking relationships with their banks. Meaning you're just a run-of-the-mill customer to them, and pretty much when you walk into a bank branch and you ask them for a mortgage, you're gonna talk to somebody at a desk who doesn't necessarily specialize in a mortgage. And that, my friends, is the biggest mistake you can make, because guess what? People like myself, mortgage lenders, career mortgage lenders, mortgage lending professionals, is all we do. We specialize in mortgages. We live and breathe mortgage. We know all the ins and outs, how to solve potentially almost any issue that you may encounter while trying to get a pre-approval or a final approval once you're in contract. A person at a bank, on the other hand, they're more concerned about a number of accounts they open every day. We're talking checking, savings, credit cards, what have you. They are a jack of all trades. Continue for yourself. Whereas mortgage lenders, on the other hand, again, do nothing but mortgages. We hone our skills on a daily basis. We deal with enough clients to know how to address multiple issues, multiple situations, and find solutions to them. As a matter of fact, part of my job description is a professional problem solver, because a person at a bank desk is not going to tell you that you can possibly find money for the down payment by getting a gift from your family or by tapping into your 401k via a loan. And if you'd like to see a video on that, subscribe, search my videos, and I talk about that quite a bit. There are tax implications involved, and that's why it's important. They're not going to tell you that just because you haven't been on your current job for 2 years, that's really not a problem. And the list can go on and on and on. We, on the other hand, provide you not just with the solutions to the possible issues and pitfalls you may encounter. We also give you a bigger picture advice, meaning you may come to a bank and they only have this many products. They only have maybe 10 to get from. That's all. On the other hand, a mortgage lender will walk you through what the best option for you is. If you come to me and ask for an FHA loan, but you actually qualify for a conventional, we're going to have a conversation as to why conventional is a better option for you personally, what the long-term implications are, why you really should not be going in for an FHA loan. An order taker at a bank, on the other hand, you ask for an FHA you will receive, without explaining to you why it may not be the best option. Do the banks normally offer better rates? Maybe, maybe not. One of the cases in point, and I've run into this multiple times just over the last few weeks, is that when you look at the bank's website for their rates, what you kind of see most of the time is one size fits all. For example, one of the rates I was looking at for a client comparing to our mortgage rates was the bank was quoting, let's say 6.6% interest rate. But you had to click on multiple links to figure out what that 6.6 was based on, really. And guess what? The client in question would have never qualified for that 6.6 because in the links that you had to dig through, in fairly small print, it showed that you had to have a 20-25% down payment, that you had to have a credit score of 780. To me, that's a little misleading. Why not just either provide a pricer or let people know that the interest rates are actually wholly dependent on their credit scores, level of down payment, and the program they're applying for? Because there is so much more to getting a mortgage than just the interest rate. And that, my friends, is really the biggest conversation that I end up having with my clients day in and day out. That the lowest rate may not be the best option for them. On any given day, normally, FHA rates will be lower than conventional. But Again, is FHA loan a better one for them, especially when the credit scores are high and especially when you have more than 3.5% down? Sometimes a conventional comes in maybe at a higher interest rate slightly, maybe, debatable, but the fact that the mortgage insurance may come in lower results in a lower payment. Maybe the fact that they're not financing the upfront mortgage insurance into the loan like FHA mandates results in a lower payment. Maybe the fact that the mortgage insurance will actually go away in a few years on a conventional loan as opposed to FHA can make all the difference in the world in your payment down the pike. Isn't that something to consider? I really want to know what you all think about this. So comment below and let me know. I want to start a conversation. And I will see you on the next one.